I just had a feeling you were going to
I know
hate it.
that, really, it makes you kind of sound like a dick, man. I mean, it's
Yeah.
you're not a
Um,
hateful guy.
okay, so what should I start with Jeff or should I start with Ben?
Start with Jeff. Start with Jeff.
Should give us
I'll
a minute to
retweet.
let
We'll
people get on.
retweet.
Oh, let's retweet while we wait for people to join.
Consumer team back together.
I'm going to New York next week. I forgot to ask you for the hotel code discounts, man.
Oh yeah. Okay. Give it this. What are you doing?
I'm going to see my daughter at Tribeca.
Nice.
Your daughter lives here now?
She does. She's working for City.
Oh, wow.
And
cool.
give the boy a place to go off campus so we can dress like a civilian, wear actual normal pants. It's exciting for him.
Cool. Give it a couple
Ben,
more
I haven't
minutes.
talked to you since the birthday party, baby. How was it?
I know, man. That was such a bummer that you fell ill.
Yeah, it wasn't the weekend I was looking for either.
No,
Yeah.
it would have been fun. We had a good time. We
It
missed
looked
you there.
amazing.
I was like, I was fighting with the host. I was like, no, Macke has a bed, and she's like, I don't see a Macke. And then finally get a text. She's like, yeah, cancel the pool. Not feeling very well. I was like, oh, bummer.
Yeah, that's the least graphic way to put how I was feeling. The it was, I mean, it looked sick, and just getting the pool reservation too. I had to go through like 9 walls of their sort of LA hipster. We don't give a shit. Like, we give you good service, but you know, we're not going to kiss your ass. Like, you know, I mean, it's a funny place. It just seemed like a good time.
Well, that's how they keep the good vibe. To be fair,
Where was this?
In there.
Oh no, it's a very practice vibe. It's a very let's hang out at the cool place, like very much.
Les Petite Hermitage at 40th birthday party there for Jillian.
You had to put in an application for booking a room.
Nah, not quite that, but it's a members club also, so it has like a bit of a Soho House. Like, you know, there's a lot of.
No, I know where it is. Yep.
Yeah, it's in West Hollywood. So no, it was good. We had a lot of fun. Maybe a little too much fun.
Yeah, no such thing.
All right, I retweeted it.
Okay, I think we can get started. Welcome to Wall Street Beats. Today is Tuesday, September 30. We are at quarter end, so buckle up probably for some volatility later in the day as people get ready to close out their quarters. Maybe some window dressing will be at hand. So I'm here, I'm Berna Barshay, and my colleagues Jeff Macke and Ben Brey are here to talk stocks. I'm going to start with Jeff. What are you thinking about, Jeff?
Hi, Berna. But 2 things. Consumer confidence just came across super weak. And before we got together, I was actually listening to the Carnival call as I was looking at Nike. So we're doing a little multitasking. The point being, though, confidence keeps missing, and Carnival was an absolute just reggae party at sea of holy crap, we can't believe how much people are spending right now. So it's hard to kind of reconcile the two. Everyone keeps telling pollsters and everyone else that you know, the world's going to hell and it's never been this bad, and then they take comfort cruises and they spend more on board. I mean, the yields are huge. They've sold out half of 2026 across all the demographics. They're serving a wide swath of consumers. So I think Christmas coming in hot. Nike coming in tonight, segueing gracefully. You pour through this company and kind of just amazing how uninspiring they are. Like it seems like you should be able to get a foothold on, you know, it's down so hugely. It's so iconic as just a brand and kind of what they projected themselves to mean. And they should have gotten a taste of a lot more of the whole athleisure, you know, business, super casual movement, and they did. And so from all that, you think, okay, they can maybe beat, but then you dig in there. It's, first of all, shockingly still expensive. So you're talking about, you know, a $103 billion market cap athletic apparel company, which is a lot. You're asking them to do a lot. They can probably beat revenues, but somehow revenues are going to decline by like mid-single digits, which is incredible after the shit show that it's been for the last 10 years or 5 years. how are you still just declining revenue? So, how excited do you get on the stock if they beat and suddenly you can buy them for only 75 times next year? I'm not sure what to do with this. I mean, it's they should be able to jam the channel. You might get, if you want to think about it, sort of 2 degrees ahead. You might get a chance to short it if it pops. I don't think it's worth playing. It's they ignored the retailers so hard for years. That should be really low hanging fruit to be like, okay, we're gonna sell to you guys again. We're gonna expand our relationship at Target again. But that's not really high margin and it's not sustainable. So I don't know. I wish I had a hotter take on it other than the consumer seems great, but they don't give a shit about Nike. But that's where we are. When they report tonight, it's there should be an opportunity. They're not. Over the last month, it's been kind of sneaky weak too. So, really, really low expectations. But you look at it like a Starbucks, low expectations there as well. Also not cheap. Also super hard to turn these huge things around very fast.
You stole my punchline for what I was going to say. I was planning to talk about Nike and Starbucks today too, and there is this sort of theme where hope springs eternal, and people think about the former glory of these stocks, and they were so. It's hard to get, your brain as a human anchors on things, and when something's really good for a long time, it's hard to imagine that the world has changed and maybe it's not going to be good going forward. So hope springs eternal. These are great brands that everybody knows. Unfortunately, everybody knowing a brand isn't the same as everybody liking a brand, and
Yeah.
both of these companies are dragging a little baggage too, I think. So
Well, they're just not cheap enough. They're not as cheap as you would
they're
think,
not
given the
cheap enough. Yeah,
sentiment that
I
they've fallen
actually
out
I
at
made
and how far the
myself
stocks are down.
I didn't have time to put it on a chart, but hand wrote. I have a little chart for myself here, which just to put numbers on this. So Nike is trading at 42 times what they're supposed to make, this 2026 fiscal year that they just began. So you say, hey, but earnings are depressed. Let's look at peak earnings. I mean, really, you would want to look at something between trough and peak earnings, assuming this is even trough. But let's look at peak earnings. So peak earnings were a couple of years ago, and they were 395. So what is 70 divided by 395? It's 18 times, which is pretty much like the S&P may be trading a little bit above that now, but that's kind of average to a little bit above average of an S&P multiple. Nike,
for a still declining growth company, for a company that
for a
still
declining
is like
company.
you're betting on the come for a lot of expansion that they're
and when it was 395, Hoka and On were a much smaller percentage of what they were now, and everybody was a few years younger, which makes every year that goes by is a year towards people not knowing who Michael Jordan is anymore. Sorry, Ben, and I love him too, but we're old. And, the kids don't care. And that's 15% of sales. That's probably going to go to zero someday, or need to be replaced by some other brand that hasn't evolved. So, is 18 times, assuming they can get there despite all the things that have changed, is 18 times, a value? I don't think so, especially given the heavy lift between here and there. And the numbers look even worse on Starbucks, because Starbucks is 39 times. Okay, so a little cheaper on current depressed numbers. The 218 they're supposed to make this year. It's 24 times, 354 that was peak. So, the only one that possibly, looks a little cheaper of these sort of fallen angels, on multiples is Lulu, which is trading at 14 times this year and 12 times peak. Although I would argue it's much earlier in its life cycle of troughing its earnings, and there could be downside to the earnings estimates. So the only one that even on a valuation basis is getting a little interesting is Lulu, but I just, the numbers probably aren't troughed yet, so it's too early.
It seems like Lulu put in a pretty beefy bottom. I'd love to hear what Ben thinks of Starbucks here. We've been talking about it a lot. It's less that you don't have something of value there once you get through it. It's they've got to go backwards to go forward. And, so you get into the situation like how good a headline is that you're just closing 1% of your stores or whatever it is. probably
And also,
bad.
like,
Those are
I don't know.
drive-throughs. Those are in
I mean,
California. Those are all systemic
coffee.
problems.
Coffee seems to have a little bit of an issue in general. I saw that Luckin is trying to come into New York, and I read the paper out of, I don't know, Bernstein or somewhere. And your Bros is on its butt back at where it started the year. It's given back the whole year, right? And
Yep.
Starbucks is close to the COVID, or not COVID, liberation lows right now. So the coffee space is not necessarily in a good spot. Even the share takers in the form of Bros, right?
Maybe that's the healthful twin of people drinking less, is people are less hungover. I mean, I'm only kind of half kidding. Maybe that's just not as much of a custom to need your pick me up in the morning. I don't know what it is, but
Oh
you're
no,
exactly
I
right.
mean,
We're at such huge
I,
saturation. We're at,
I don't
it's
know
just not
about
they're not getting their share.
I don't know about where you guys live, but I think it's independents are killing them. So, not on the highway at a rest stop, and maybe not in a suburban area, but in these in dense cities that with high traffic, high productivity stores next to big offices and stuff. So much independent competition. So in the however many hundred stores that I'll give you an anecdote that they closed three in, within 10 blocks of my apartment in New York City. And I think what really gave me pause is about Starbucks is one, how they sort of pulled off the closing, and two, um, people's reaction to it. So how they closed these stores. There were people literally who had just bought coffee last Friday, and they're sitting in the store at 3 o'clock, and like the store gets a call and says, "We're closing. You have to leave." Like they
Yeah.
literally, threw out the people.
I mean,
They
you know what
didn't
I read into
give
that, Berna,
people they didn't give
is
people like
nickel.
a few days notice, so that if they
They
actually
didn't they
had a
didn't do
connection
it.
to their barista, that they said to get to say goodbye to them or tip them or do anything.
They
So
don't
it's like
want to say
they want to
goodbye
be
to
the
them. You
third
know what
place
that tells me,
again.
Berna? What it tells me is they've got a culture problem. Nickel's a culture guy. What I liked about Nickel is he goes into the stores and he really wants them to have a good vibe, right? Like 4 minutes, let's reach that. Let's have a little team meeting up front. He has to be going nuts with all these kind of hippies and the unions and just this weird, unique to Starbucks stuff, getting sued because they made people dress in a uniform to come to work. It's like, what the hell is that? That's just freaky to him. When I hear you on the close down, it's really jarring. I think they did it because they were trying to minimize the press of if they would have announced it and given all the unions and everything a foothold to say, they're shutting down the troubled stores, because they did. They closed a disproportionate number in California, because it's really expensive to run a coffee shop here. And because it's a super lefty type of place where you're paying $25 an hour or whatever it is to get kind of mediocre barista help, that's a hard business model. And it's
Right,
really
right.
hard to turn a culture with 10,000, 20,000 units. First of all, which is probably a third too many, but it's these are niggling problems that slow any process that you can really make on that turnaround, and it just becomes a multi-year, super long problem before you even mainline it, before you even get down to
Mhm.
kind of what's the base here.
Yeah, and I mean, to me, it just to me that just was an operational unforced error. Like I can see the mental logic behind it, but like if the first thing you're going to do is put a piece of paper up with a QR code on your door that says "Come find the other three Starbucks in this square mile," or actually like more like 10 block radius that are still open. Maybe what you don't want to do is kick out the people. Like it's like you just burned a whole bunch of people, and everyone's talking about it in my neighborhood. So anyway, that's one thing. And then the other thing that was just amazing to me was, at a different store that they closed, they put up the sign like "Come find us, here's the QR code," and somebody actually printed out a sign that looks, as official as the Starbucks sign of "Here are 4 independent coffee shops with great coffee and lower prices that are within 4 blocks of you," and they put their names and their numbers. And it obviously wasn't done by one of the stores because all 4 stores were on there. And so that
Yeah.
just to me is like people have bad vibes around Starbucks. And when I went to look at the online discourse, and this is obviously hyper local, everyone was like, screw them, big corporation, union busters. I mean, granted, I'm in lefty New York, as he put it, lefty California, but I remember during the pandemic when the Starbucks first opened, there were posts about like, make sure you tip $2 on your $8 coffee because these people are working hard. And, there was a lot of, I remember,
Yeah.
there used to be a lot of warm feelings for our neighborhood Starbucks, and it seems to somehow have turned ugly. And the other thing that I want to mention about things turning ugly, uh, the public discourse on Nike Skims is not great. Like,
Not great.
it's not great. I mean, first of all, I don't think personally, as somebody who's a large consumer of athleisure, I don't think that the product looks all that great. I saw some comments online that, there were also criticisms like Kim was ripping off her ex-husband Kanye's looks. I could see that with maybe the basketball shorts. I don't know. I can't comment on that, but the online discourse on it was not super positive. It just actually looks like more of the same. Like, to me, there was nothing all that exciting about it. I mean, the thing that really struck me is like we've sort of moved into this wider, looser silhouette, and of 58 pieces, like 55 of them are super tight, which is the Skims thing. That's their sort of MO, is body conscious, body skimming. But
Yeah.
I don't know. It seemed to me to be sort of not really on trend. The colors were kind of boring, and I was sick last weekend, so I couldn't go to the Nike store or the Skim store. But I asked some people who were, in Midtown, and they said it was not particularly crowded. There wasn't a lot of buzz around it, given it's been months and months, and there are billboards all over New York for this. Like, I would have expected more, and in a more quantifiable and less anecdotal piece. I went through last night, and of the 58 pieces, I think 56 were still in stock, and I hit on about 10 of them, and there were only a couple that had broken sizes. So, I don't think this is the launch that Nike wanted. I mean, they're going to have to talk about it on
Yeah.
the, because it's been, it only have been 4 or 5 days, so they can really make up whatever they want and spin it however they want. But I would keep a close eye on the online discourse on Nike Skims. Not that Nike sort of, it's going to move the needle on Nike, but certainly if it had made a big splash and everyone was talking about it and excited about it, then it's something that could have gotten the stock going. And I
It's
don't.
hard to be cool if you're going to be 50, 75 billion or whatever they are a year. It's hard to be both of those things. We've got a mall out here that has an Alo, a Viore, a Lulu, and a Nike all lined up, and so it's just a great vibe check type of place. And really, it's you can't do too much with vibe check on a multiple basis, but you can walk in a store and say these guys don't have any idea what the hell they stand for. Kind of, it's a generic, here's a place I buy basics. It's like become a Macy's of athletic stuff. It's not exciting. It gets it done if you really need to go there, but it's, like you say with Skims, the discourse only went down. They buy a brand and the brand becomes mediocre. And that's sort of where they are right now. And they're not really cutting edge on much. They keep promising turnarounds and you can't see them yet. And it's really hard to get that excited when it's been so long since they've really innovated much of anything. It's hard to see them getting on the curve in a timely type of way. It's a little bit of the Lulu problem where it's like, boy, we've kind of got a little bit of a headwind. We finally have reached back some sort of athleisure penetration. Now we're in a new business now. We're in the denim business. You don't see the denim companies. Levi's up 30-40% this year. They didn't promise brand new jeans. They didn't say, boy, we're going to come out with something that's going to be an exciting innovation in cutting edge denim use. They're just going with the standard issue. Hey, here's a jean jacket. Your butt will look kind of good in these jeans. Just your basic, this is how we advertise because it's denim and everyone's already seen it.
And everyone's wearing
Nike is,
denim.
everyone's wearing denim.
Everyone's wearing denim. They're not wearing yoga pants. That's just what's going on.
Really?
So, oh
Yep.
yeah. I mean, I just see everybody wearing denim, young, old.
Wow.
Mostly wide leg, some classic, but it's funny because I started getting
The 80s are
it
back?
probably
You're
means
saying the
nothing to you
80s are
guys,
back?
but like I've been getting like TikTok videos where people are like, jeans in a going out top is back. And this was sort of like the rallying cry of the early aughts. Like, you put on your jeans, you put on your going out
Yeah.
top, it's like some kind of like camisole shine, sort of shiny silk in the top, maybe something with some sequins or whatever, and jeans in a going out top, and you were good to go. And that's coming
And
back.
denim's kind of a staple. And what
Hopefully.
they've done is they've gone from 2% growth to 6% growth. Is that super sexy and fun? No, but it triples what it was before. I mean, holy
No,
crap,
but
that's a
on the
great
margin,
tailwind for them.
it's great for companies that sell jeans. I mean, so getting
Right.
to
But
the
if you're
trade,
Nike or Lulu getting back to kind of 8%, that you still have to take something out of the stock. Like the stocks are still too expensive if you just
yeah.
make them into staples and you say there is no longer a tailwind. Like we've got the stretchy pants, we all have tights. It's going to grow with GDP, give or take. And
But
if
it's
those are what
possible.
it's becoming, it's a problem. These are
Yeah.
still expensive.
Well, I mean, Lulu isn't, but if it really made, if it really made 13 and it was going to make 13 next year and 13 the year after that, or 13.25 or whatever, it would be not bad. It would be 14 times for a very high margin business. The problem is, are those margins going to hang in? And that's like the $1 million question there.
We're 6 quarters past when Lulu used to say we are a full price company, and they used to declare that in big, shiny, huge font, which is, they don't ring a bell at the top. They just claim to be a full price company where,
Oh, you know
we
what?
never give discounts because we're beyond that. And it's like, you do now. Everyone
Speaking of
eventually kind of has to go there.
Speaking of a full price company, I mean, I think this is something interesting to note for Lulu is this $300 Amex Platinum credit that's going in for next year. I don't know how many Platinum cards there are out there, but everyone who has a Platinum card, it's probably something that I should have Googled, but I've seen some analysts make comments like this will be a driver of comps, because basically if you have an Amex Platinum card that is you get a $75 100% credit back for the first $75 you spend at Lulu every quarter next year. Now, I go into Lulu like twice a year. I have a platinum card. You bet. I'm going to go into Lulu and I'm going to spend $75 every quarter because it's free money. It's free stuff, right? And they have that for Saks. By the way, the last retailer they had that for was Saks, which is clinging to not going bankrupt. So, I don't know if that's a good sign or not, but Saks, you get like a $50 every 6
And a
months.
bowl of soup. I mean, it's Saks a little hard up.
But the thing with Saks that was interesting is there's not much in Saks that's $50, right? So a lot of the times, I'll buy something that's $300 and I'll get 50 off, right? Or if you want to be really disciplined about it, maybe you could get like a lipstick and a mascara or something, like a piece of 1 to 2 pieces of makeup for $50, and not spend over and really just get your free money. At Lulu, there's a lot you can buy you can't buy yoga pants, but you could buy a top and a pair of socks or something. You could buy a long sleeve shirt. Like there are a lot of things where you could walk in, spend $75 and not spend more, and do that 4 times a year and just get free stuff. And I don't know how much of that Amex pays for and how much of that Lulu pays for. It's certainly shared. People were talking about, some analysts were talking, sell side analysts were talking about how this is going to drive comps next year. Like it's going to drive comps, but it's not going to drive margin, right? Because they're giving
right, and that's the thing about your $13 earnings. It's like they're not gonna earn 13. They are post peak earnings, kind of for the next few years, because it costs something. The Amex deal costs something. 5 years ago, Lulu would walk down the street and say, "You're an Amex Platinum customer. We just own you anyway. Like you're buying our crap anyway. So what we're gonna do is a little bargain we call sell you stuff at exact full price." And hopefully we still have it when you get here because we're not saving it for you because we own that upper level demographic that's going to wear tights. Now they're paying for it. So how do you build that into a model? It's not that it's a terrible deal for Lulu. It's not that it really drags the brand down. It's that it's marketing. And so we have to figure out for this company, what's it going to cost them to market? Maybe not as much as Nike markets, but something. They're going to pay something. And that's not in the stock yet. Those margins until the foreseeable future, it's like that just figures to be kind of a how fast are they declining type of thing. And until you know where the bottom is, it's hard to argue cheap or expensive for almost anything.
I mean, it's just interesting that a lot of this stuff, when you think about something like the Lulu thing, like my first thing was, oh my God, how bad? My first gut reaction is, how bad have things gotten that they need to do this? Because it's so promotional. To me, it reeked of desperation, because I'm thinking about the long-term value of the brand, the hotness, the durability of not what it's going to be making next year, but what it's going to be making in 3 years, because that's what my brain thinks about. The sell side analysts that I saw that were like, oh, this could drive comps, they're not thinking about what this means for 3 years. They're thinking about what does this mean for first quarter earnings, second quarter earnings, and in 2026. Which is sort of like it gets to the point of like the trade versus the investment and like the DCF sort of durable value of the company, which I think brings us back to Nike because it's to me, it's a tough trade, right? Because I mean, I'm not getting involved. I think we've made it clear all the reasons we don't want to own Nike as an investment. You know, I'm less sure of what the trade here is because, as you said, they might beat earnings based on this sort of inventory flush and stuffing the channels, and just trying to clear the decks. That's entirely possible. If the margins don't collapse on that, I mean, as a betting person, maybe, given how washed out it is and how it's been trading into this, maybe it goes up. Now, I still don't want to own Nike, but if I was a trading person, would I, are the odds on the quarter to the long side? Maybe. But, that's not the game I play. Yesterday I noticed that Kering was up like 26% this month and 80% in the last 6 months, which is a company where nothing good is happening either. It's Gucci peak earnings 2 years ago. It's the same story, but in Europe and in luxury. And, it just had a super whiplash move, really on nothing improving, but maybe vibes, because we just had Milan Fashion Week and the new people are kind of jazzed up maybe about their new designer and stuff. So I think that the point you made that it takes a really long time to truly turn the ship is that is 100% correct. And, that's the long-term value. But in terms of the trade, because hope springs eternal on these names, I wouldn't be, as negative as we are on Nike, I wouldn't be shocked if it went up on these earnings.
But
it could be up 20%. We could shit on them just as easily tomorrow. It almost doesn't matter.
Exactly.
But a lot of these consumer stocks have had that nice move from the Liberation Day lows and now are replumbing the lows. Like our friend Dave and Buster's, goes from $15 where I bought it. It gets to 33 and now it's back at 18. Nike's now plumbing, getting closer. They put up a bad print, it will be back at the lows. Our friends at Restoration Hardware are got back down sub 200 or right on the neckline of 200. I think you're seeing this all over the place because I think kind of what happened is there was a lot of buying into the liberation tariff announcement, and that perversely was an economic boom, like a mini boomlet. And then now we're having the other side of that start to come into effect. And I know the tariff SCOTUS is coming in November. I think the market has it about 60% in favor of the White House right now. I would find, even despite the legal ramifications and what the legal argument is, I still think it'll be hard to see them not rule with the White House. It's just kind of the world we live in these days, sadly. And so, it's just I don't think it's a good time. And so, even like we were talking earlier about bros, like guys who are doing well are having a bit of a tough time right now, So the Levi, actually, it's funny you mentioned Levi. I messaged my buddy who runs a denim factory in Mauritius while we were on the show. He said there's a big oversupply of denim globally from the supply side. So he's a non-branded, if you need, he'll sell to anybody. And so and he said Levi sets the price. So if it's coming back in demand and you have an oversupply situation where, you get a margin expansion story. So makes sense why the stock's been doing well. But I don't know. You see like CarMax 2 weeks ago or a week ago, and that was lower volumes, lower prices, the ultimate bad combo. The stock got dropped. There's been two auto, subprime auto, Tricolor and First Brands, BKs. So if you open your eyes, you can see some softness all over the place. And I think, why would Nike be able to offset that? Lululemon.
Well, I'll see what you're saying. Throw up the chart of Nike that I've made again. It's not just because it's awesome artwork, but because it also shows if we can do that, Jen, it shows a lot of these stocks got back to where we were in January. And you see, I've got it highlighted there. That kind of the end of January was when the White House came out and they were like, no, we were serious about all that tariff crap that we were talking during the election. Like, we were totally serious. They're going to be random. It's going to be a shit show. And that's where we are right now. So Nike's got $1 billion in tariff expenses, give or take, that they got to shuffle around and they have to mitigate, which means we're going to raise prices someplace. They have shrinking margins in the first place. It's hard to get to a point where you say, I'm going to pay more for this company than I would at the end of
Yeah.
January, because all
Yeah.
their expenses are higher and nothing is really trending their direction. And so you get to those multiples, it's like, you know what? We're still making up crap as we go along on tariffs. So however they're going to impact this company really doesn't know any better. And I'm not going to pay more for it now, with margins having declined to some large but unknowable amount that's still fluctuating. It's just hard to pick up the names.
And it's hard. It's a hard strategy to say, "Hey, I'm going to pay more for a pair of pants or a shirt for a brand I don't really love." Like a out of favor brand trying to raise prices. Like, good luck with that strategy. You know what I mean? So, my guess is they'll be eating those costs, and so declining margins, no sign of turnaround in the brand. It just, you pull up the longer term chart on that and it's just down to the right? It's one of these share loser charts that, like, the kind of thing is, if you're like a fundamental, what summer was that? There was the summer of, so 21, right? So the bubble people in 21, and it was the whole direct to consumer theory or thesis, and it was like, hey, they're going to cut out Dick's and they're going to cut out all these guys, and it didn't really work in their favor, right? And that was 170. Now we're here at 70. Excuse me, 69 actually, and not a great 3-year run for the Nike.
No, and that's two different CEOs, a couple different strategies, a few different ideas, and here we are.
You made a good point about a lot of companies sort of flirting with their Liberation Day lows, those April lows, because Nike is, a good 20% above those, which is, something
for today. We'll see where they are after the close today. We'll see where they are after the close today.
I mean, to be 100% clear, I have no idea what the trade is, but I wouldn't touch it with a 10-foot pole. They're just better fish to fry, because as you said, there are companies out there that are doing well that are getting shellacked because of, the consumer confidence number, the concerns about tariffs, the concerns about the consumer, all those things. And there are companies that have shown no cracks in their results yet. I mean, it's at highs, but as you said, like Carnival is a company, I mean, it sold off a little bit yesterday, but put in, really a quarter that it was very hard to jab any holes in. We've seen this pattern every quarter with the cruise companies, is like, they beat and raise, but they don't raise enough. And, they guide very conservatively, and they sell off a little bit on the earnings. And then, business continues to be good and they go up intra-quarter and they sell off on the earnings. Like this has been happening all year with them, because the beats are getting smaller, just because of the law of large numbers. But objectively, sort of on an absolute basis, business has shown no cracks. It's decelerating its growth rate because, trees don't grow to the sky on pricing. It's
got a gazillion dollars worth of debt. And so Carnival, when they're paying down debt, things are going really well. And once the margins tighten up a little bit in bad economic times, real bad economic times, which we're clearly not in, it becomes just you're counting down the days of liquidity. And so as a result, they're really not expanding right now. They got so kind of upside down during the COVID that they're not really able to invest in as much growth as they would like to, which is the strange thing about cruises. You would think that you'd think there'd be more cruise liners under construction than the entire fleet on every ocean in the world right now,
there's
just
a lot
because
of
the industry is so
under
hot.
Construction. There definitely are,
but it's historically kind of in line. It's historically not as much as you think, because I thought there'd be a glut, and it's like there's just not that much supply coming online now. It's just an interesting space. Again, it's a company that I'm not that excited about, but a great quarter.
They had to do a huge amount of capital restructuring after COVID, right? So I think their balance sheet constrained of how much CapEx they can
completely.
Do. And I think that's part of the story, right? Like, I think that supply, I don't want to say constraint, but that supply rationality is part of the reason why these stocks have worked, is the boomers are taking cruises, and it's a relatively cheap vacation, And
It's not boomers anymore, Ben. That's the thing. There's been a huge surge in millennials taking cruises. So
well,
that's
also
I think
because
what's really
I think it's a cheap vacation. It's in a world where hotel prices have gone to the moon. You can say, hey, let's go on a cruise. Here's the price. It's pretty cheap to get on those boats. They make a lot of their money with the booze, right, and the on boat stuff. So I think that
Yeah.
that's part of it as well. I think it's a economically relative economic type of vacation, for
yeah,
the,
it's
the
at a
material.
discount to the same experience on land and that's always been the pitch. Although interestingly, I think where the biggest capacity expansion is at the very high end, like the Regents and the Silver Seas, like the type of cruise that you just took, Jeff. Like that is,
Yeah, we Silver
that
Seed, and
goes
But
I'll
with
that's
the
a
tell you
K
one thing they're
small.
economy,
doing.
right? Like, oh, it's a small piece of the
It's a
business.
small,
It's
but it's
like,
a nice
Yeah.
margin,
10,
and
15% of the
the Alaska
business.
cruises are a good example. Carnival side of Alaska doing very well, and they're doing this model elsewhere as well. But they just kind of build up little experiences in those ports, which is relatively inexpensive. They go places where the weather's doing 90% of the work. In Alaska, you go there and the scenery is doing all your heavy lifting. You don't need to make the Magic Kingdom there because that's kind of what the place is. So you throw in a zip line in a nice restaurant, and all of a sudden that's a little resort. In Denali, they've got Carnival. They have the whole Princess line of an actual resort where you're staying in Denali, which is not a super expensive place. It's getting up there is the hard part. They get you there, and then they actually have the experiences on the other end. And so it's just all inclusive means a lot of different things. In that case, it means they're getting 100% of your expend on your entire vacation because you're always with them. You're always at the Carnival kind of place. And so in lieu of boats, they're just kind of whacking areas out of, cutting a deal in these small towns in Alaska, creating the experience and keeping every dollar the consumers spend. It's a pretty savvy little business. I mean, it's not terrible.
Jeff, was that your first cruise that you took this year?
In years, in literal decades. And so I haven't
Yeah.
been
So
on one since the 80s.
I mean, I went on a cruise, short one, just like a 3-day one this summer, which was also my first cruise since I was 12. So my second cruise of my life, first one since I was 12, and the only one I took. Reason I took the one on when I was 12 is they were trying to introduce a New York to Florida route, like
Yeah.
all those years ago, and it was cheaper than flying. So my very thrifty dad put us on the boat instead of the plane. So anyway, yeah, I mean, just look at us. Like, here's three people, two people who probably thought they were never going to cruise, and we both did it for the first time.
Well, to be fair, we got old too. So, I mean,
Yeah, we did get
it's,
old. Well, it was my
we
tween that
met it
actually.
halfway.
I got shaken down into I went on a Disney cruise, so I got shaken down into the cruise, being my kid. But it's interesting. Disney's going from a couple of years ago, they had 4 ships, and they've been in the business about 30 years, I think. I think by the end of the decade, they're going to have 13 ships. So,
and they're also building little parks on the other end. And so, you land in Aruba, and look, it's like a little Disney Aruba thing. We put in one roller coaster.
Yeah, they're private
live the magic.
destinations. So it's interesting. I mean, I think that, the other thing that we may be seeing is like this, which has been going, it was the trend before the pandemic. And since the pandemic, it just got interrupted by the pandemic, which is just people wanting to spend money on experiences over things. So, a couple of years ago, people were feeling more flush, floating, rising tide lifts all boats, no puns intended. And, now people have to make choices because your groceries cost 25% more than they did 18 months ago. So when you start to have to cut back, are you going to cut back on the third pair of sneakers, or are you going to cut back on, your trip? And people seem, to love their trips. It's a pretty simple thesis. So.
I mean, you're a parent. We always use the 5-year test. What am I going to remember in 5 years? That's the thing that you're better off doing, and it's not going to be the shoes because they're going to be kind of destroyed by that. It's going to be the experience. And so that's, it's nothing is the best tailwind in the world that gets you out of so many problems. And Nike and Lulu, they don't have a tailwind right now. Denim has a tailwind. That's just consumer demand. That's just kind of which ways the wind blows. People are taking cruises. It's you can see they've just got a place in kind of our weird fascination society. There's Netflix, 3 of the top 10 at one point were just disaster stories about a woman being abducted and the poop cruise. Just experiences that you would think no one would ever take a cruise again, and the demand is insatiable. Carnival's
I mean, it's
sold out
crazy
for
because I
half of
don't know.
next year.
Have you seen the fights specifically to Carnival? Like they have like all these videos on TikTok of people getting into like these huge violent fights on Carnival cruise lines. Yet it doesn't seem to affect people's interest. Like if you told me that bar down the street has great drinks, but like one night a week, people just start fighting, I would
Right.
be like, no,
There's
thank
occasional
you.
stabbings, and police kind of just shut it up. There's not actually cops here, so to speak. We have it's marital law, and so it's kind of we can make people walk the plank and stuff. That would be a bar you wouldn't go to, but noroviruses and stabbings aren't a problem for the business.
Yeah,
It's just people want to
it's
cruise.
definitely the people who love it, love it. I mean, I'm not 100% sold, but I won't be an annual cruiser, but it probably wasn't my last one either. So,
Yeah.
but the people who love it, they really love it. It's kind of like people who love Disney really love Disney. It's a cult, but a profitable cult.
And good luck fighting it. If your kid loves Disney, you're screwed. You're just do Disney. Don't try to convince your kid to have taste. They'll grow out of it, but you're gonna do that when you have youngins. So it's a powerful inducement.
So let's move on. I know, Ben, you had something to talk about that wasn't retail, so maybe we should try to get that in before we wrap up.
Oh yeah, I think one of the things I noticed today, Meta's down 1.5%, 2% today. They announced another, this, if we look back at this September, it's going to be the September of absurd announcements of 100 trillion there and a quadrillion there. And hey, by the way, these
and
aren't
the Oracle
binding
circle jerk with
agreements.
everyone else.
Yeah. Oh, hey,
Oracle's
I'm
going to buy
NVIDIA
Oracle's going to buy everything. Larry Ellison's going to buy everything.
Hey, I'm NVIDIA. I invest in CoreWeave, who's my customer, and NVIDIA's gonna lease or rent back their chips from Lambda to then lease them to them, and $100 billion to OpenAI. I mean, the whole thing's ridiculous. Ed Zitron had a great piece that was outlining all the numbers and just the absolute absurdity of this OpenAI stuff, and like how they need $1 trillion. There's no money for this. Like anybody who thinks there's this not the capital in the world. These numbers got too big, basically. And today, so anyway, back to Meta. So when I was in St. Bart's at Hugh Hendry's event, I was a speaker down there, and Mike Green had given me a couple lay down on this Meta, and I started looking at the numbers. I pulled down one of the big brokerage houses models. They have some cash flow issues, and so you can see this chart. That chart looks like it's broken, and it's given back the whole September month. So today they announced a $14 billion compute deal. I don't know if it was binding or not. I didn't get through it all the way, but with CoreWeave, so CoreWeave's up, but they're down 2% today, and this is the first time I've seen one of these announcements where on the announcement the stock's down. And I think I'm not the only one who understands that these guys have some cash flow issues, because they got $100 billion of operating cash flow. They're on the hook for $75 billion of capex this year. Street has them as $100 billion next year, but then they got to do $32 billion in buybacks and $5 billion in dividends, and they got a working capital. They're already leaning hard on their working capital, so I don't think that's going to be a sort. If anything, that might be a negative cash flow hit. So their cash is going to go down, and it can't be surprising in the deal they did in August for a $29 billion data center, 5 gigawatts down in, or 1 gigawatt down in Louisiana, that they did it as a variable interest entity. And if that sounds familiar to you, that's what Enron used. So it's basically off balance sheet leverage, but they have the recourse on it, right? So if they terminate the lease or the value of the data center goes below a certain level, it's on them. So, Blue Owl put in $3 billion equity tranche and PIMCO put in $26 billion. So they did this again. And so I just think it's interesting to note that the market reacting negatively to this is the first time I've seen that. And Meta's starting to leak and underperform the rest of because the Qs are near the highs, right? And Meta's 8% off where it was at the end of September. So
okay, but let's be clear though. It's it's outperformed most of the Mag 7 this year to date, though, hasn't it?
Let's look at the year to date chart.
Hold on, I have them. I have this
I
on my
mean,
screen.
it's up 13%, or something. Not even.
Meta year to date, it's
Yeah,
up. I think it's up about 25.
I don't.
It's no Build-A-Bear.
No Build-A-Bear for
Oh,
sure
Build a
not.
Bear.
So up 120. Yeah, so it's up 20%. Okay, so yeah. But again, I'm just saying it's starting to leak. And like the when you look under the hood, they have some cash flow issues. So what they're gonna have to do is either lever up, cut CapEx, or cut buybacks. And you look underneath the hood, they lost a lot of their AI guys that they hired this summer, and there's an app where a lot of engineers go on, and it sounds like it's a mess internally. So I'm kind of keeping an eye on them, because I think if somebody's gonna slow the capex, go flat, or even say, hey, we're gonna do less capex, they'll be the ones, because I think they have the weakest cash flow situation. Plus, I think that one thing not talked about enough with OpenAI is that they hired away the head of ads from Meta for 11 years. She was very good at her job. I don't know if you guys been on Instagram lately, but there's more ads than there is impressions, it feels like. And so I think OpenAI is going to transition into doing ads. And more, it looks like that's what they're going to do, because I don't think the subscription model can support what they're talking about, with all the $1 trillion of capital they need. So they move into ads. That's a new competitor for ads for Meta, right? That'll be a new direct competitor to Google and Meta. And that pie is only so big. And if the economy is slowing, I don't care what you say, advertising still is cyclical spend. If your business isn't doing as well, advertising does slow. So it's something to keep an eye on, basically, is my opinion.
Yeah. I mean, it's interesting because the problem with all these stocks, well, not all. I mean, problem with Google and Meta, because those are the ones that I'm really deep into, is that, for now, on an if you're looking at income statements, it's hard not to be bullish because they continue to be share takers. The linear universe continues to be a share donator to them. It's kind of like Jeff Charts about the shoes, anyone but Nike, when you have like a weak zebra, kind of giving away share, they've been a beneficiary of that for so long, and it still continues. And within the digital universe, Meta products, Meta ROAS, return on ad sales, like the productivity on Meta is just unmatched, and it continues to be a share taker within the digital world. It's hard to find, people who aren't happy with the product and what they're getting out of it. So as from an income statement, let me just finish. It seems a little early to me to be negative on it. That said, all these companies have, what I would call a balance sheet problem, like not in the sense that they have too much debt or they're in any kind of financial insolvency, but like just the whole AI expansion and the return on capital that they're going to get on that expansion. It's even in the best case scenarios, it's going to be, these used to be asset light businesses that just had unbelievable ROIC and ROE, and all of a sudden they're capital intensive. So it's sort of like, if you look at the income statement and what that might look like for the next year, it's hard not to be bullish. But if you look at the balance sheet and how that's going to change over the next year, it's hard not to be bearish. And
I mean, but I'd say this: they're toying around with their accounting assumptions, and all these guys extending the useful life of these data centers, and that's just another thing that's showing from a gap point of view, you're over earning, right? And so
totally fair,
I,
yes.
I, I would just say that you need to stick with the cash flow here. I mean, they're up to paying their suppliers up to 5 months. That's bullshit. And basically, they're just leaning on guys. And I'm just telling you, I'm doing a private deal for ByteDance right now, and I can get ByteDance at 6 times EBITDA. Okay, TikTok's revenue is just as big as Meta now, and Meta's like 19 times EBITDA. What would you rather own? I mean, I know there's some Chinese discount. I know you hate
TikTok
Chinese stocks,
Global, right?
Berna.
TikTok Global, you're saying
Global,
is
TikTok Global, 6 times EBITDA versus 19 times EBITDA, and that will be public next year. I'm just saying, I think people are looking at Chinese AI stocks, and that's why they've been ripping this quarter. And money can come out of these things, so you can still wait along. But the Meg 7 is decelerating still growing decently, but decelerating top line, accelerating capex. And Jeff, you tell me, at Stanford Business School, was that a good combo? Was that the combo you were looking for?
The bullish argument, it's the bullish argument with Meta is that they retain the mind share kind of the form factor, right? They've been through this before, and so when Facebook was just something that you had on your PC or your desktop, that was a real problem for them. It wasn't at all clear that they were going to own the smartphone interface the way they actually came to do. They got Instagram, and boy, that turned out to be a pretty damn smart idea. Turned out to work out pretty well for Google to buy, YouTube. That was smart. And so it's when you see Meta's getting so much more out of what they spend, at least in a tangible way, compared to like Apple, who's still stuck with kind of those scuba diver, this is really going to be how we do AI. Meta itself was a joke because they were doing those similar goggles. I'm wearing Meta glasses right now. That's going to be a big thing. If they can actually figure out a way to make just kind of eyewear become how you interface with the web, that changes quite a bit. That would be mastery of a third form factor with AI on your face. That's kind of, is that a smart bet? Not really, but they've done this kind of thing before, and that's what Zuckerberg's trying to do now is kind of maintain that dominance. It's not an easy thing to do. Who knows if they run out of altitude before they actually stumble on something that's mass marketable. But it's early stages. It's just kind of a large but unknowable. If AI didn't get any bigger, you would still be able to just have super cool glasses that allow you an interface to use it in a more seamless way than whipping out your phone all the time, which we've gotten used to, but that doesn't mean it's the way we're going to continue to interface.
Well, they're losing $21 billion on that as well, and we'll see if they can make money on that. But I guess that might be the first. Yep. So they're going to have to something's going to have to get chopped, is what I'm telling you. If you just look at the math, the numbers, something's going to get chopped. They cannot continue as they are right now. Like the street's numbers are wrong.
There's only so many guys you can hire for $100 million a guy. It's like, even in the valley, you run out of people that you can pay that much.
All I'm saying is that 100 billion of capex is a 26 number, 21 billion, 22 billion in the reality labs, 37 billion of cash out the door for investors and to stop the dilution from their employee stock comp, and then again, they're not going to get a source from the working capital. So either they're taking leverage up, they're cutting something, and that's about it. Like one or the other. And so I don't know if it's going to be the glasses that get cut, if it's going to be the AI capex get cut. But I will tell you what, the fact that they're doing off-balance sheet debt tells you that there's already stresses coming. There's accounting red flags showing up. There's Enron style off-balance sheet stuff. These are not the things you see in a bullish scenario, is all I'm telling you.
And we're really early in the discovery of that. Not a lot of people are talking about
exactly.
I agree. It's off balance sheet balancing.
And it's kind of interesting what brought them down, when they crashed in 2022, what brought them down was excessive CapEx spending.
Exactly. And that's what I'm saying.
On it. That's what drove it from whatever it was, 400 to 100. I can't remember.
I bought it. It got lower. I bought it at 92.
It went under 100, went to like 90, I think. That's when I was.
That's because they were dedicated to the metaverse.
The stock that I own is the stock that I bought then. I was right there with you.
Exactly, and that's what I'm saying is I think that their core business is fine. I'm not arguing with what their core business is at all, right? Like what I'm saying is all this investment is where the problems are showing up from, and we don't know what the return on investment is going to be on this. And there's a lot of players trying to be in this space. I think the 20 billion on the glasses is very speculative. And, at the end of the day, their decisions are going to have to be made. And all I know is competition's rising and capital intensity is rising and revenue's slowing. And that tends to be not a great combination. That's all I'm trying to say.
And Meta may be the poster child for, most likely to be affected by these questions, given, everything that you said about the accounting and the cash flow. But, there's the larger question of what the ROI is going to be on all this CapEx spending.
Absolutely.
Across the entire, it's what made me, one of the things that made me sell Apple last year, that, too early, by the way, but, it just not knowing what the return on the spending is going to be. And, I would say across this, it's certainly a problem with Tesla as well.
Well,
I mean,
Tesla's. Let's finish off with Tesla because I mentioned that about CarMax, and I think people on the show know I was supportive of and owned Goodyear Tire, and I got dinged hard on that. And my takeaway from the Goodyear Tire experience this summer, and was the auto supply chain is a total disaster, and the auto business is a total disaster. And I was like, you know what, Ben, that was good. Listen, don't. I had a good run in autos, so I started thinking. I was like, "Oh, I can trade autos." Well, let me tell you something. The auto space has changed, and CarMax told you that. These bankruptcies in the space are telling you that. I don't know how Tesla and Carvana are trading where they're at. Now, I'm not saying, "Oh, we got to short them here," but they're definitely on my list of things I'm looking at and of potential shorts. Carvana, and one thing I tell you is the guys who own those stocks are tech guys. So my experience when tech guys own specialty finance or cyclicals is that they're not the smartest guys. They're not the same level of cynicism that's built up into financial, cyclical type guys, right? They're used to secular growth. They get in the secular growth story, and so Carvana's been one of the best. I think it's actually been the best stock of the last 3 years. It was at like $2 or $3, and now it's at 400. So I don't think there's any stocks that
it's
were
had a
better than
move.
that. He's had a Build-A-Bear style move.
Yeah.
I think people who own Tesla spend 75% to 80% of their time thinking about autonomous vehicles and what's happening, Waymo versus Tesla. Like if you just go and read what the titles of the sell side reports are, that's what people are thinking about. They're thinking about the
Tesla
AV
scarcely bothers
They're
to
not-
talk about
they're not
cars
thinking
anymore.
about the
They really
auto
don't give a
cycle.
shit about cars. It's a crazy, like this mind fog. People somehow have just taken cars out of the equation in terms of the valuation of Tesla
insane.
entirely. They don't care.
Yeah,
They
it's
just don't care.
it's
going
like
to
an
be
afterthought.
something magic is going to take its place, and we're going to do AI, and Elon also owns the rockets. Shit, the guy's an impressive guy, so okay. It's like, do I want to bet against that? I don't know. But it's not a car company anymore at all.
I would argue the same thing about the Google and Meta calls. They maybe spend 10% of the time talking about the advertising market when it's where they're making 90% of their revenues. Everyone's just, fascinated.
Well, they got to
with
try and
AI,
keep the multiple.
Which goes to Ben's point. If the car market crashes, no one's actually looking there. If the ad market crashes, no one's looking there because everyone's just thinking about.
Well, until they don't, right?
Yeah.
I think
of course.
I think that everybody takes for granted that $37 billion that Meta's just giving out every year of the cash flow or whatever the number is for Google. If you had the core business get hit, people would start caring very quickly. I think right now it's just taken for granted. But the Tesla thing reminds me a bit.
Long. But Tesla, it's not even like their car business is great, but people are they've moved on from it, and it's AV and robots.
Well, that's what I was going to say. The Tesla is sort of like Bitcoin. See, if you guys I followed Bitcoin since 2010, 11, basically. And the narrative on Bitcoin has changed over the 15 years. The meme has changed from, oh, it's a new financial system to, basically now it's like, oh, digital gold or there's been multiple narratives. And I think with Tesla, it's the same thing. It was electronic cars, and then it was full self-driving cars, and then now it's robots. And as long as you can keep the attention in the cult of belief and just believing whatever the future thing is, it's kind of like that guy Russ Hanneman in Silicon Valley when he says just be pre-revenue, because then you can just tell a story. You don't have to show any results.
I mean, it's a good story. It's like Ellison said about Elon Musk. Musk was getting trolled, and Ellison writes back, and he's like, I'm in Florida. I'm about to watch a machine catch a rocket descending from space designed by Elon Musk, and you're some guy at an internet. Yeah, it's which one am I going to bet on? I'm probably going to bet on the rocket guy because he's doing something really cool. I mean, that really helps the fog if you can actually point to shit. There's a rocket that was launched last night out here. That's super cool. It's like, wow, the world's richest man's doing neat things for the collective amusement. But it's kind of nice to see it streaking across the Southern California sky at night. It's like, well, I'm not sure I want to short the guy who privately funded a rocket company. He seems like a formidable opponent in terms of being on the wrong side of that trade.
for sure.
Yeah,
Well,
and so no, I don't have any more comments on it. I just think that it's a very interesting thing, and that's what makes those hard shorts is because when your narrative drives things, rational analysts like us don't. We can get ran over, and shorting
Right.
stocks in general is much shittier payoff structure than being long stocks. So you
It's a
got to
super
really.
lousy business to be screaming at your computer about what dipshits everyone is. This is insane that I'm losing money today. It's just an awful position to be in. Like it's
It's a hard way.
really,
It's a hard way to
that's
live your
not where
life.
you want to be.
It's a
it's
hard way
funny,
to live your life.
you guys know I stopped shorting, in the last couple of years. And I have to say, as somebody who was like a diehard short seller for 20 years, the only ones I miss are the zero shorts. And like, because those are the only ones that I think the return on time is actually a good proposition, The
I
return on
think
We don't
time
have
serious
is
time
short
to talk
sellers,
about
that's all
Beyond
they
Meat.
do.
what's that?
Like serious short sellers, they try to like find the ones that are zeros.
Yeah, I mean
because
those
then you can
are the
stick with
ones I
it through
truly enjoyed.
confidence.
And those are the ones that actually like pay off on time because it is so much easier to find something, except for like 3 years in my career, it's so much easier to find something that's going to go up, that's going to go down,
Right.
All right.
So anyway, well, we've gone really
Let's go do
long.
other things for a living.
Yeah. Well, anyway, happy quarter end, everybody. Fun being on with you guys today. And we'll be back tomorrow. Come check us out online, Wall Street Beats, on passes.com. Thanks for being here.